Your social circle is anything like mine, your friends are probably going crazy for stocks and shares. Revolut have made the stock exchange so accessible. And in this COVID crisis, stocks are going down, stocks are going up, they're going all over the place. And certainly one or two friends of mine have suddenly become overnight gurus. Respect to them. I would have thought kind of being a guru in this space would take absolutely years. It's a space I've become really, really interested in over really the last year, 16, 18 months. And to that end, I'm a big believer in finding mentors, and I recruited this guy, Owen O'Malley, and his partner, Anna, to really help guide me in the space and to really, help educate me, help me with investing, and essentially hold my hand. And over the last couple of weeks, they've been phenomenal in the advice they've given. So I asked them to do a quick Zoom call, a quick Zoom interview, because we're all isolating. But yeah, I just wanted them to share their perspective in kind of the situation that we're in right now, where perhaps the opportunities really are, how to read those opportunities, and how to do your research for yourself. So I hope this is of value to you. It's very different, obviously, to the content I more normally share, but please do let me know what you think.
Guys, thank you so much for joining me on this call. It's very, very much appreciated. I wanted to have a call and share this out on my YouTube channel because I am fascinated with the stock market at the moment. I'm seeing like shares crash through the floor. I'm hearing that there's so much opportunity in it. And obviously I'm kind of learning to appreciate that all the more off the back of working with you over the last year. But what I wanted to do is have a chat and share as much value as possible with anybody watching on. And so to get started, very quickly, could you introduce yourselves?
Yeah, my name is Owen O'Malley and this is Anna Rodriguez, and we help people to make money.
Very simple. Boom, boom. And specialized in stocks and shares. You guys were very good to take me into your investment club network, where essentially you train people in the most unbelievable baby steps, that sometimes as I was learning, I was like, oh my God, I can't believe we're literally doing plus and minus. But actually it's really appreciated because this space is simple when you're taught it the right way. But frustratingly, a lot of people seem to make it really, really complicated.
Yeah, as I say in my book, So You Want to Be Financially Free, become financially free is down to simple, basic primary school maths.
Yeah.
Also, you see, there are so many moving parts that some people could be good at some of them, some people could be naturally good at others. And by putting everybody together, groups together, we can tap into whatever somebody else is good at. And that creates a lot of strength.
Yeah, you need three basic skills to be successful in the stock market. You need to be able to recognize patterns, because the stock market is a measure of human behavior. So humans behave in repeatable patterns, and you can see that in a graph of shares going up and down. And it's simple that shares tend to go up for 1 or 2 weeks and then down for 1 or 2 weeks, and then over longer time frames there's recognizable patterns. So the first skill is visual skills, just to be able to recognize the patterns. The second skill is to be able to analyze a company and be able to know what's important. And people like engineers, architects, accountants, people that are good with numbers gravitate easily towards that. And the third skill, and probably the most important skill, is to be able to see into the future. And that's the thing that people lack. People that are good at chess, people that are good at planning for the future, people that are good at logistics, run logistics companies, they have that ability to recognize that the past is history all over with. The present moment is what we have in front of us, but the ability to be able to see into the future and plan into the future is exactly what you need to be successful. Right now, we're on a significant 10-year low, and this is an 11-year low. This is a tremendous opportunity for those people that can see into the future. So when you put groups of people together that have those three skills, analytical skills, visual skills, and ability to see into the future and plan into the future and have a clear strategy into the future, you have a very powerful group.
And that would be part of it. Part of the project is how you physically do the things, is the mechanics behind it. And that's part of it. But the other part, which is very important, is the psychology behind it.
Pure psychology.
Because unless you feel that you deserve to have money, you won't make it. You've figured out a way to sabotage yourself.
Absolutely. As people often say, the stock market is a mirror of who you are as a person. If you're one of these people that gets distracted easily by something else, we call it the shiny object syndrome. and you're always flitting around looking for this, and then you move on and do this and that. Well, the market will kick you back, because unless you've got a clear long-term vision and long-term plan in the market, you won't succeed. And as Anna says, it's all about psychology. One of my great teachers, Sir John Templeton, said if you can master the market, master your emotions, you will master the market.
Yeah, and this is not new, Jamie, if you think of it, because look at all the people, think of people around you, and they would always have the same kind of partner. Or the same kind of job where they are unhappy, or the same kind of, we tend to repeat the same situations with different characters until we learn the lesson.
Well, this for me has been fascinating, because, you know, chatting, I'd love to say sitting around friends, but obviously we're all in isolation, so we can't. But certainly I was on a a Zoom call actually with my friends, and it's very interesting. Obviously some think it's the end of the world. Others have suddenly overnight become stocks and shares traders and know everything. Of course, we're all following the various stats of, you know, how many people have tested positive for COVID, how many people are dying in certain countries and all that. It's very interesting how in times like this, people shift into different spaces. But one thing for me, I've always been obsessed at looking at how people react. And I remember a lot of these conversations going back to, in Ireland, the property crash, and seeing how people were like, oh, it's the end of the world. And at that time, there was obviously one of these all-time kind of once in a decade opportunities to buy into the market. And it was only following that time that people said, Jesus, they made absolute fortunes in the stock exchange, but I wasn't looking at it then. And as I said, thankfully, due to the time we've spent together, I've been kind of sitting in the middle of this and recognizing, right, okay, everything's looking very doomy and gloomy. Shares are going through the floor, and that's really scary. But with a bit of perspective, there's a real opportunity here. And do you mind me asking, zoning in on that? Like I think of the property crash. I heard of the dot-com bubble, but I think I was a bit too young to appreciate then. But because I always think kind of balance comes from perspective, and what are those similar times to now that perhaps might help people get a bit of perspective in terms of where things are and where things might be in the future, or will be realistically in the future?
Yeah, but so I've been actively involved in the stock market for over 20 years, working with investment clubs and people, and like you, Jamie, observing human behavior. But we've had 10 major corrections in the last 20 years, but we've had two big ones, really big ones. We had the dot-com bubble burst in early 2000, because everything was completely overvalued. So that was a genuine problem. The market was genuinely overvalued. The NASDAQ was trading at 10 times book value, and the S&P 500 was trading at 6 times book value. Shares normally trade at 3 times book value. So that was a natural correction of valuations, and that took about 14 months to unfold. The NASDAQ dropped about 80%, and the S&P dropped about 50%. But you hit a very important word there. When people think it's actually the end of the world, if you study a guy called Robert Preckner, who studied the psychology of the markets, who's interviewed by Tony Robbins and Power Talk, he talks about the fact that when you're at the absolute worst possible narrative in the world about, you know, the world is all over, that is actually the turning point. When it's at its worst, it's actually at its best opportunity point. The second thing we saw was in 2007, 8, and 9. And again, that was a genuine financial crisis, because the banks completely over-leveraged themselves, individuals over-leveraged themselves, property investors over-leveraged themselves, and that was a natural correction that needed to happen. But what's happening right now, and the irony of what's happening right now, is that this is not a financial crisis. It wasn't an overvaluation crisis. Before it happened, the market was trading just slightly above average, but not significantly above average. And so what's really ironic, Jamie, is back in 2000, market dropped 50%, but it took about 14 months to unfold. Back in the 2008, 2009, the market dropped 58%, but it took about 18 months to unfold. What happened with coronavirus, and I mean, you were right in the middle of it, talk about the perfect storm. It dropped about 40% in a very short period of time, about 6 weeks. And so it's been totally blown out of perspective. You used a very key word there, perspective. I want to throw a curveball at everybody out there watching this. I get that coronavirus is not a great situation. I get that America wants to save lives. I get that it's looking like it might come in at around about 60,000 deaths. And one death is too many, as they say. However, let's have a bit of perspective. The flu happens every year in America, and they, on average, you're talking somewhere between 30 to 40% people naturally die of the flu every year. 40,000, sorry. But however, if you Google it, everybody, I challenge everybody to do this. Go on Google from 1970 to today, which is what, 50 years. The average rate of abortion in America is 1 million per year. So they're happy to go out and take 1 million lives a year, and now they jump up and down because we're going to lose 60 or 70,000 people with coronavirus. So again, there's a bit of perspective for you. But right now, when it comes to making money in the market, this, for anybody watching this video and listen to this podcast, this is a tremendous opportunity. You only get this happens once every decade, that you get some things so ridiculously lowly priced. Some shares we're looking at right now, Jamie, are at 11-year low, 15-year low, 5-year low, 10 years low. And as I say to my students, you only get a 10-year low every 10 years. So you've got to wait another 10 years to see an opportunity like this in the market.
I was following, I'm a big follower of Anthony Robbins. He brought out his book Unshakable, and he did so many interviews which all talked about this moment. He was like, the moment's coming when in time the markets are going to crash. That's your opportunity to jump in. He talked over and over. I remember an interview with himself and Gary Vee where they both talked about having a lot of money in cash waiting for this very moment.
Yeah.
And there's no doubt that it knocked, like there's certain shares, and I imagine you'll be able to share them specifically, the ones that will not be affected by this, but in the long run, but their share price was dramatically. Of course, there are ones like, for example, say travel or hospitality shares that will be flattened by this and will probably have a much slower growth curve off the back of this. But what are some of the shares that, for no other reason than just the fear associated with this, dropped quite dramatically?
Yeah, I mean, there's one there that absolutely makes no sense whatsoever. It's a company called Goodyear. They own the brand. They make the Goodyear tires, the Dunlop tires, and the Kelly tires. And they were trading for $40 before this, and they went all the way down to $4 at the worst. So they dropped 90%. Now, we all know legally, most countries of the world have an NCT test where you go get your car test. We all know if you don't have enough rubber on your tires, you have to repeat the test. We all know the police can fine you for not having enough rubber on your car. So think of all the lorries and cars in the world that need tires. It's going to continue. So there's an example of a company that's actually, its book value is $20 if it goes into liquidation, but it's actually, you can now buy it for around about $7. And there's nothing fundamentally wrong with it. It has positive cash flow, very strong balance sheet, just all of the fundamentals are in place that it's rock solid. And there's an example of something just completely ridiculous, dropping 90% just this event.
It's funny, like I think obviously, you know, when we say, look, the market follows patterns, everything dips, everything goes back up again in time. There obviously is a bit of perspective in terms of looking at the environment. This is going to dramatically impact travel. So I'd be avoiding that side to a degree, although obviously some of those shares have really fallen low, and so there is still good opportunity in them. But what I can't get over is the shares that exactly like them that have fallen dramatically for no other reason other than the fear, and it's just a case of a month, 2 months, 3 months before they pop back up, and so there's a really good opportunity in them. That makes complete sense to me.
It does, and if people understand the stock market, what actually happens is, it's when something like this comes along, this what's called panic selling, and when somebody sells, and then it causes somebody else to sell, and then there's even another thing, once a share goes below $5, then institutions dump it as well. So there are various milestones along the way to the bottom that just, we know why it happens, but it doesn't make any sense for anybody who's got any intelligence.
Yeah, because the companies are still doing the same thing. You see, if a company is making shoes, they are still selling shoes. We still have feet. This is that they are on sale, but they are not on sales in the shop, they are on sales in the stock market. But it's exactly the same company. And if they are big enough and they've gone through challenges, and you see, people will still keep buying shoes. It's just an example, but that's the way it works.
Sure.
I was just going to ask, I'd love to zone in on exactly how you read the stocks, because, you know, I've chatted to so many friends who, because of this, and to be fair, because of the accessibility of buying and trading now through Revolut, so many of them are doing it. And it's almost like the very marketing that some companies have done is actually influencing the purchase of their shares. So for example, say I'm sitting around the table and the shares that get mentioned are Netflix, Disney, Amazon, Apple. And I kind of said, well, you know, why are you buying this share? And someone said, oh, gut instinct. I feel this, I feel that. Which for me, I'd be a little bit scared because I do think that when so much of the market is impacted by people's instincts, it's important to kind of separate that out and bring a bit of clarity to that. So how do you approach looking at a share and seeing if there's value in it or if there's an opportunity to buy?
Yeah, now some of those companies you mentioned are great companies,
Yeah.
but their share prices are ridiculously high. They're overvalued. So the first thing we look at is, anybody out there that ever thought about getting involved in property, there's a simple equation you can do. You can buy a house for 100,000. You can put 10 tenants and collect maybe 10,000 a year. You know it's going to take you 10 years for you to get your money back if you've used your own cash, or if you've borrowed money, it might take you 20 years. That's just a simple calculation. What's the price of my house divided by what's my earnings? So that's what's called the price divided by earnings. It's the PE ratio in the market. So the PE ratio on average is about 20 in the market. The market on average charges you 20 times earnings. So if you can find a company, and GT is another good example, where the PE ratio is 10, you're at a 50% discount. And if it's below 10, you're even a lower discount. So I think the GT PE ratio at the moment is around about 7. That's one very simple equation. You can look at the balance sheet. You can look at how much assets it has versus liabilities, how much surplus it has on its balance sheet. You can look at the debt to equity. You can look at the cash flow per share. You can look at the earnings per share, the dividends per share. There's only about 6 or 7 simple maths, as you said, plus, minus, and a bit of division, and you've got it in a nutshell. So I've seen so many people jump into companies that are way overvalued. So there's not much more upside. I mean, there was a guy, one of our club members from Galway was having a conversation with me yesterday. He said, oh, we should get into gold. Well, if you actually look at the graph of gold, gold hit its low. It hit its 6-year low 5 years ago. Gold is almost at a 5-year high, and percentage-wise, there's not much more to go in gold. And then I said, well, hang on, why don't you compare oil? Oil is at like, it's never been this low. Oil, I mean, the theory value of oil 2 days ago was minus $7 a barrel because of short selling and stuff. So oil is the cheapest it's ever been in the history of the world. It was around about $128 a barrel. It's in theory worth nothing right now. So I was telling him, like, the oil graph, I sent him the 2 graphs, the oil graph and the gold graph. I says, look, if gold's at the top when you're thinking about buying it, but oil's at the bottom and you're not thinking about buying it. You've got to ask yourself, why?
Yeah, and when you hear Owen, your friends might say, oh my God, I just follow 10% of it, if any. I would like to say here that I understood nothing about the stock market 7 years ago. My background is science, nothing to do with this. I didn't even know the words in my own language, let alone in English. Everything is learnable. Owen was saying a lot of blah, 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 blah. Maybe to you it sounded like blah, 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 racial. Because that's how I felt not that long ago. Everything is learnable. We teach it, and it's way simpler than it sounds.
Yes.
Do you know, I have to jump in there. It's so funny, isn't it? We spend so much time working our asses off to get money. And then when it comes to investing it, it's almost weird. There's something in our heads that switches off. If you're looking at an insurance policy, it just becomes 3 or 4 times more difficult to concentrate on it. A mortgage, savings, interest rates, and then, stocks and shares. It's like there's something inbuilt into us where we work. And then when we get the money, we just, it's bizarre.
It's all about education, Jamie. My son Jaime, he's 19, and he has been investing in the stock market for a year now, and with demo accounts for 4 or 5 years.
Yeah.
And my youngest, he's not even of age, and he's already investing through in an account that is on my name. But he know this. They know that there are opportunities there. Yesterday, they were telling me about this opportunity of buying some options to buy cars in Tesla for the future and to make a business out of it. They are thinking that way. Why? Because ever since they were very young, we were teaching them about money, about making money work for you. about the value of knowledge and applying the knowledge, about putting money in different envelopes. They were tiny and they saw me every month to put this is the envelopes of money. This money is for the house, this money is for investing, this money is for typing, this money is for blowing, this money is for long term. And we traveled with that money. They saw what it was going to. And they know the value of money.
Yeah, I taught my son when he was 6 years of age how this all works, and he was studying value line reports at age 6. And at age 8, we opened up an account and we give him real cash. He's been trading real money since 8 years of age. And our system is very simple. You can look at a graph, as I said earlier, about shares going up and down every 2 weeks. You can see something that's 7 today that might be 9 in 2 weeks' time. You can actually tell the computer, when you get to 7, buy automatically, and when you get back up to 9, sell automatically. And that's how my son started at age 8. While he was at school, in national school, kicking football in the schoolyard, he was making money because his orders were triggered automatically back home in his online account. So making money is very, very simple when you know how. The biggest challenge is the psychology, as Anna talked about. If you can master your psychology, you will master the market. It's very simple.
Yeah, that's actually something I have to say I'm really happy about. Looking at the likes of, say, for example, like Revolut, making the accessibility to invest all the easier. Like I think back to when I was 20, and I didn't know of any other way that you could use money or invest other than property. And you know, my family were involved in property, so that's why it was familiar to me. But it's amazing how few of us are brought up with any kind of real understanding of money. I think the principle of, for example, like pocket money, which is a once weekly small amount of money that parents will give to their kids, teaches every bad habit in itself, because it's teaching people to get used to a weekly wage. I remember really fondly a chat that I had with a friend who came from a history of wealth, and in their family they did pocket money every quarter. And I think as things progressed, initially it was every quarter, and then as things progressed, it became every 6 months. And of course, initially when he was 7 or 8, he spent all his money at once, and then the family pretty much starved him thereafter. So he learned how to budget, and then they started introducing a bit of investment. And God, by the time we were 16 or 17, he was trading. He was phenomenally financially savvy, versus the rest of us who really didn't have a clue what we were up to. Do you mind me saying, you mentioned Value Line, and you were talking about the figures previously, but I know Value Line from obviously what you've taught me. Could you just give a bit of an insight into that? That's obviously the go-to source for this information. Would that be correct?
Yeah, correct. And success leaves clues. If you want to be the best at any profession, find out who's the best, copy what they do. So in the world of investing, as Tony Robbins interviewed 50 of the wealthiest people on the planet for researching his book, Money Master the Game, which then became unshakable. People like people like today, Sir John Temple's passed away, but people like Warren Buffett, Carl Icahn, and Charlie Munger, they're the best investors in the world, and they use valueline.com. Who's valueline.com? They've been around since 1931. They give people like you independent, reliable information that you can trust. They're paid to find out what's wrong with the company, not what's right with it. They're paid to be pessimistic about companies. They give you solid information, independently reported, updated every 3 months on a PDF report, but updated every week on their website, valueline.com. So that's a source of information. It's reliable, it's conservative, it's something you can trust, and something you can hang your hat on. So that's simple. Everything you need to know about a company is on one piece of paper. It's literally the 15-year history. Everything's happened in the company in the last 15 years, and everything is probably going to happen in the next 5 years. So you get a 20-year history of a company on one piece of paper that you only have to read every 3 months.
Plus, there's also information about the industry itself.
Yes.
If you want to look into it.
Sure.
So if I'm breaking things down in terms of what we've talked about so far, essentially it's always get a bit of perspective on the situation that you're in, and life follows patterns. And for however doomy and gloomy things look right now, and for however bad things are, if you look back on our history, you'll see that there's been similar times, and so there will be similar times in the future. But what follows the kind of place that we are right now is that things rebuild and things grow, and a year's time, 2 years' time, things settle and things normalize and things rise. And so with that perspective, if you detach yourself from how bad things are right now, there's actually a real opportunity or a real sale in the market. You do have to obviously use your gut instinct with regards to every market correction will bring with it a correction in terms of how things will move forward. So as I said, it'd be quite obvious that travel will grow quite slowly off the back of this. But a company that, for example, say sells tires, well, no, everybody's going to be out driving fairly soon. So I don't think there's a huge issue there. Companies like that are going to bounce right back up. Companies the likes of Facebook, the likes of Amazon are only going to grow and do really well. Apple, similarly. And then when it comes to looking at those shares, obviously you don't get carried away by what your friends are saying, but instead you go to an authority, for example's sake, like Value Line, and you weigh things up on the PE ratio. Is there any other kind of quick ratios that you'd look at just to kind of build a little bit more confidence before making an investment?
Do you want to jump on that?
Yeah, some of the ratios that we look at is the book value that Owen was talking about before. I think a little bit. The book value is if everything that a company has, if they were to a garage sale, how much is that worth? And now what's the price in the market? So that gives you an idea. Normally it's about three times the value in the market is the price in the market is the real value, the liquidation. If we're below, if we're 2, 1, or even below, that's fantastic. That's sales.
Yeah. So for people out there, if you think of if you bought a beautiful, a beautiful site somewhere with a nice scenic view. So you bought a plot of land, you know exactly what that land cost you to buy. You built a house on it, you know exactly what that house cost to build. Let's say you buy a nice house for around 300,000 euros. And then someone comes from America, they're from the area, they emotionally love the site, love the view, and they offer you 900,000 for the house. Well, they're paying you 3 times what it actually cost you to make it. So you building the house is the book value of the house. The American paying you 900,000 is the market price. That's what the market is prepared to pay you. And the stock market is exactly the same as Alan said. Shares normally trade at 3 times book value. And right now, we're finding shares. In fact, Warren Buffett said it in his book, Tap Dancing to Work, which he wrote in 2013, everything he's ever done in his 60-year history is in that book. And he says, the reason I've been so successful my whole life is I always find companies trading close to book value. Right now, because of this opportunity in the market, we're actually seeing shares that are trading significantly below book value. Like, for example, that GT example, if GT went into liquidation, it's worth $20 a share, that's its book value. You can pick it up today for $7. So it's like 2/3 below book value. Once in a decade opportunity. Another common sense ratio that we can use is if we look at the Value Line projections for a share to go to, right? Let's say that this example that we're looking at, 7, and the Value Line is saying, I don't know the numbers, but imagine that it's 45 to 70.
Okay, so it's going to trade between 45 and 70. Look, we're at 7 now. What's the reward to risk ratio? How much further down can it go? And how high up can it go? We want to see shares whose prices at least 3 times more likely to go up than to go down. Yeah, Tony Robbins. That's common sense, really. Yeah, that book you mentioned there, Jamie, Unshakable, and the previous book, Money Master the Game, when Tony interviewed 50 of the wealthiest people on the planet, they all talked about exactly what Anna said there, but they used a word that people don't understand. They used a word called asymmetric risk, meaning that there's more opportunity to go up than go down. And that's the key thing that everybody he interviewed said. There must be, I look for asymmetric risk in the market.
I always think it's funny how people will start speaking a different language when it could be all said so much more simply. It's like people do want to overcomplicate things. When in actual, and the stock market is dramatically overcomplicated. Certainly from my experience together with yourselves, that it's the more I learn, the more I'm realizing that actually it's quite straightforward. It's just you have to get past the jargon-like language.
You do. I often say brokers are a bit like mushroom farmers. Any mushroom farmer knows to be successful, you got to keep your mushrooms in the dark and you got to feed them with shade.
Yeah. Nicely put. Well, look, I think we've kind of covered. I think the kind of key takeaway right now is that there's a huge opportunity, and rather than finding yourself really drowning in the doubt, the anxiety, the fear that is everywhere, it's worth taking a few steps back from that, looking back from where we've come to see patterns similar to this and know that they will only follow going forward. And with that, there's a huge opportunity at our fingertips. It just needs to be realized. Now, Owen, you've been so good, and Anna, you've both been so good to me in terms of anytime I've needed a bit of help. Thank you so much. But I couldn't believe how accessible you've been over the last few weeks and months. And so I would imagine you're somewhat similarly as well, if anybody's watching on or following. What's the best way to connect in with yourselves?
Anna T. Iceland.ie, Anna at Tango Indigo Charlie November.ie.
Yeah, Anna with one N.
One N.
ANA, yeah.
And just to share with people is that we haven't even touched on the fact that you can generate an income from shares, which is, as we all know, we can buy a property, generate income, we can buy a car and drive around using Uber and make your car make your money for you. In the stock market, you can actually generate income from your shares as well, which is a whole world that we want to open up to. Most people don't know it exists and don't know how to do it, but your shares can give you significant income as well.
I thought that was mind-blowing how few people are actually conscious of that. 4% of people that trade, isn't that correct?
Yeah, the volume in the market is 96% is buying and selling shares, but 4% is actually generating income from shares. And we're talking about three forms of income. You can get dividend income, which people know about. You can get call option income and put option income. That can all be reinvested in your portfolio of shares to buy more shares to use the compound interest. It's called the wheel. It's the wheel. You just reinvest.
The way you put it to me is that's the equivalent of 96% of people that are investing in property not actually having anybody renting the property, but instead just hoping for the price to appreciate or rise in value. It's incredible.
Absolutely. If you knew a landlord that had a house sitting there empty and yet in Dublin people are screaming out for accommodation, say you're crazy, man, you can put people in here and collect rent. So that's what's going on in the stock market now. We feel like saying to people, look, do you not realize with that share it is an asset? Doesn't matter whether it's Amazon or Apple or GT or whatever, it will generate an income for you. And that's a trick that people are missing in the market.
Well, that being said, that whatever, not all shares are optional.
Yeah, well, 10%, but the top 10%. So,
yeah. The cool ones, the good ones, the strong ones do option.
Yeah.
Well, look, I suppose, do you want to stop the recording? We'll have a kind of a bit of a follow-up chat then. Is that fair?
Sure, yeah.